Ladies and gentlemen, good day and welcome to the Anupam Rasayan India Limited Q4 FY23 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Krishna Patel from EY Investor Relations. Thank you, and over to you, ma'am.
Thank you, Tanvi. I'm pleased to welcome you all to Anupam Rasayan's earnings call to discuss Q4 FY23 results. Please note a copy of all our disclosures are available on the investor section of our website as well as on the stock exchanges. Anything said on this call which reflects our outlook for the future or which could be construed as a forward-looking statement must be reviewed in conjunction with the risk that our company faces. Today, from the management side, we have with us Dr. Kiran Patel, the Chairman, Mr. Anand Desai, the Managing Director, Mr. Amit Khurana, the CFO, Mr. Vishal Thakkar, the Deputy CFO. Now I shall hand over the call to Dr. Kiran Patel for his opening remarks. Over to you, sir.
Thank you. Good evening and a warm welcome to our Q4 FY23 earnings call. I hope you all are doing well. The year 2023 continues to unfold additional challenges for the world, starting with the banking crisis unraveling in the United States, also having some impact in Europe and the rest of the world. Continued inflation and higher interest rates, along with the ongoing Ukrainian conflict, all contributing to the uncertainty on the economic front. The true test of leadership is measured by the ability to navigate through these turbulent times safely. Anupam is fortunate to have a great team under the able leadership of Anand Desai, who is driving our long-term goals of becoming one of India's largest players in the specialty chemical space. Anupam has been strategically investing in technology and infrastructure, human capital, research and development to achieve this goal. To elaborate further on the technology front, our manufacturing infrastructure is a class apart. We were probably one of the first few companies who have started using the continuous flow processes in early part of 2013, helping us win and sustain the confidence of global clients and which aids in further new client acquisitions. Moving on to our investment in human capital, we have expanded our business development team. The testament of this expansion is our recent wins in Japan and United States with this new development. On the green initiative side, we have installed 17.9 megawatt solar power plant, which will provide us with savings of 14 crores per annum. On the strategic front, the recent acquisition of Canpac has allowed us to further build upon the existing fluorination portfolio. On the R&D team, this robust team has allowed us to build complex chemistries at competitive cost, which allowed to demonstrate our capability to the customer. The recent LOIs signed are a result of this strategy, and I will let Anand discuss this in greater detail later. As part of our long-term growth strategy, we also continue to evaluate multiple strategic inorganic growth opportunities across geographies to further consolidate and accelerate our growth trajectory and offer our customers a complete solution for their requirements. I can assure all of our shareholders that we will continue to be cautious and selective in the evaluation of these opportunities. And like the acquisition of Genpact, we will acquire companies only if they are strategic and value accretive to Anupam. Before I conclude, let me congratulate our Anupam team on our FY23 performance. We have delivered a robust revenue growth of 20% plus in FY23, driven by various contracts which we signed during FY22 and 23. Circling back to what I had alluded earlier, all the levers which we have been working on for years are now converging, and the results are a byproduct of the same. I will let our CFO Amit and Vishal discuss financial numbers in detail later. On a closing note, amidst the weak global economic backdrop and headwinds, Anupam is shining well due to our planned long-term strategy. With this, I hand over the call to Anand for his opening remarks, and I would like to thank you all once again for joining us here tonight. Over to you, Anand.
Thank you, Dr. Patel. Hello and good evening, everyone. Welcome to our Q4 FY23 earnings call. It gives me great pleasure in sharing that we have continued our robust growth momentum with a consolidated top-line growth of 41% on a YOY basis to the 1,601 crore rupees, and standalone top-line growth of 20% on a YOY basis to the 1,284 crore rupees. This growth was driven by three important factors. The first factor was commercialization of 5 new products during the year. Second is steady growth of our organic product portfolio. And third was strong performance by Concall. This growth augurs well in the backdrop of a trailing year in terms of supply chain issues, raw material pricing volatility, sticky inflation, and other major economic events that have impacted the world at large. Despite these challenges, not only have we been able to deliver a strong growth, but also have been able to maintain our margins. This validates our business model and long-term strategy. On the operations part, we continue to focus on adding more value-added products in our basket, as well as bringing financial efficiencies. We have already started witnessing the results of the same, which is visible in stable margins and improved working capital, resulting in a strong cash generation of 244 crores from operations. Dr. Patel mentioned about our investment in infrastructure, talent, and technology, and how this has helped Anupam in achieving this robust growth till date. We shall continue to capitalize on these platforms for creative and further invest in strengthening and expanding this pillar of growth. Let me expand on some of this. On infrastructure, during the last 5 years, we have incurred almost 1,000 crores as CapEx, which has created manufacturing capacity and which has resulted in growth of over 26% CAGR over the last 5 years. Further, this CapEx will also support similar growth for the next couple of years. Further on, the LOI contract signed and the strong demand along with new inquiries from global customers for fluorination-based molecules, and due to which we have announced CapEx of 670 crores for 3 new brownfield projects to service the requirement. And this new capacity will ensure growth for the next 3 to 5 years. Coming to the point of talent, we remain focused on investing in talent acquisition across functional areas, specifically in R&D. Our team size grew by 11 times to total 88 professionals as of end of FY23. Looking at the project pipeline, we have planned to double our R&D team in FY24 to 175 scientists. Further, we have added 12 experts in business development team across US, Japan, Europe, and India. All this existing and new talent pool will help us strengthen our product development and customer relationships. On technology, we have launched 5 products during FY23, most of which are manufactured in India for the first time. I wish to applaud our R&D and business development team for their exceptional work in synthesizing these molecules in a record short time with our distinctive processes as well as scaling them up to a commercial level. We shall continue this momentum and we target to launch 10 products in FY24 in various segments, including niche, pharma, and electronic chemicals, and again, these are for the first time in India. With the backdrop of recent geopolitical events, the world is changing significantly in terms of supply chain management and vendor control in favor of reliable long-term supply chain partners, especially from India. They are presenting us with many opportunities that are value accretive and sustainable. I am happy to share that with the recent LOIs and contracts signed, our cumulative value of LOIs and contracts has reached a total of rupees 5,500 crores, which are to be supplied over a period of 5 to 7 years, and which significantly improves our growth and revenue visibility. At the same time, we further remain in advanced stage of discussions with customers across geographies for many niche and high-value molecules. I am more confident than ever of also delivering robust growth in FY24. With that, I would like to hand over the floor to our CFO, Amit Ghai. Amit, please.
Thank you, Anand sir. Good evening, everyone. I will discuss some important financial updates before handing over to Vishal Bhai for his remarks. Let me begin with an update on the CAPEX. Throughout the year, CAPEX was around 177 crores, which was largely spent on building new capacity, solar projects, R&D, and general CAPEX. In FY24, we expect CAPEX to be around 350 to 400 crores. Our asset turn for FY23 crossed 1x, and further we expect it to grow significantly in FY24. I would like to reiterate that new CAPEX will have an asset turnover of over 1.75x. In total, we have budgeted to do CAPEX of 670 crores for 3 brownfield projects, which will support the signed LOI contracts and demand for fluorinated molecules. On the working capital side, we have been able to bring down our inventory days from 291 in FY22 to 250 days in FY23. We have been able to achieve this improvement on account of high focus on working capital intensity as promised last year. We continue to focus on working capital intensity and expect it to reduce further to a more comfortable number by next year. Strong revenue growth, stable margin, and better working capital cycle has helped us deliver strong cash flow from operations of around 244 crores. I am confident that we will continue to generate robust cash flow in coming years, which will make us self-sufficient in the future. Cash on the books as of 31st March 2023 was 551 crores. This, coupled with expected cash flow from operations in the coming quarters, will be sufficient for the planned CAPEX. With this, I hand over the floor to our Deputy CFO, Vishal Bhai, who will take you through the financials in detail.
Thank you, Amit Bhai. Hello and good evening, everyone. Thank you for joining us here today. I would like to briefly touch upon key performance highlights for the quarter and the year ended 31st March 2023. And then we'll open the floor for questions and answers. Before I proceed, I hope you all have had a chance to go through the detailed presentation submitted to the exchange and at our website. Kindly note our numbers for the quarter and year on a consolidated basis include 10 fact numbers. I will first discuss the consolidated highlights for the quarter ended March 31st, 2023. Operating revenue for Q4 FY23 was at 4,800 million rupees as compared to 449 million in Q4 FY22, up 48% YOY. EBITDA was at 1,416 million in Q4 FY23 as compared to 969 million in Q4 FY22. Growth of 46% YOY, this would translate into a 28% EBITDA margin. Profit after tax was at 726 million rupees in Q4 FY23 as compared to 461 million in Q4 FY22. Growth of 58% YOY. On full year basis, the operating revenue for FY23 was at 16,019 million rupees as compared to 10,738 million in FY22, up 49% YOY. EBITDA was at, including the other revenue, was at 439 million rupees, 4,399 million rupees in FY23 as compared to 3,100 million rupees in FY22. Growth of 41% YOY. This would translate to 27% EBITDA margin for the year. Profit after tax was at 2,168 million rupees in FY23 as compared to 1,522 million in FY22, a growth of 42% year on year. Please note, consolidated numbers of FY22 does not include Pentrack Industries numbers. Okay. As far as revenue breakup is concerned for the year, in terms of geographies in FY23, the contribution from Europe was 30%, India 36%, Japan 16%, Singapore 11%, China 4%, and remaining 2% was from US. For the year was around 64% and continues to be a major contributor to the revenue. Our top 10 customers contributed 82% of the total revenue, and there is total 24 products that we provide to them. As we continue to add more customers for the various value-added products having better margin, we will continue to see contribution from top 10 customers moderate in coming years. With that being said, we shall open the floor for Q&A. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, if you wish to ask any questions, please enter star and 1. Participants, if you wish to ask any questions, please enter star and 1. First question is from the line of Vidit from IIFL Securities. Please go ahead.
Hi, good afternoon, and thanks for taking my question. Just if you could share some, further color on the 3 new LOIs that have been won in the last, couple of months. Just in terms of what was the edge that Anupam had that the customer selected Anupam as a first-time manufacturer in India, and also in terms of when revenue from these LOIs is likely to kick in.
Okay. Let me this is Vishal. Let me try and address it. And Anupam, please add if I have missed on to something. First, if I were to add and say where we are coming from here. If you see, these are all the molecules that we have been working for a long time, and these customers are the customers where they have seen our relation with our other customers and the kind of quality of services, and most importantly, the technical capabilities that we have demonstrated for them in terms of synthesis, in terms of speed at which we have been able to deliver, the quality that we develop for them, and most importantly, the supply chain solutions that we can provide. Because as you can appreciate in custom synthesis manufacturing business, the key thing is, as we are part of their supply chain, can we also demonstrate to them that our supply chain is robust enough to provide them a consistent supply over a period of time, because these are all contracts with them ranging from 5 to 7 years in terms of the initial relationship that they start with. So that's one part of it. And as we talked about fluorination, basically, if you see, this was the work which we had started 6 years back or more. And that now is coming to fructification because of the supply chain that we have created here. Right? And that's what is coming into play. Of the LOIs that we have signed this year, we will be able to commercialize at least a couple of products in this year, and balance others should be in the next financial year.
Okay, so anything at the beginning of the year, all of this would probably bring in revenue on a full scale only in FY25. Is that right, or is that a correct way to understand it?
Yeah, you can see that way, because the large part of the volume will come in the next year and the year after. So if you look at, typically there is always a ramp up, right? And that ramp up will take a couple of years. So that's what we are saying.
Understood. And these customers, are they existing customers, or are all three of them new customers that we've won? Because I think the presentation says you've won one new MNC. So is it fair to assume that the other two are existing customers giving us new molecules?
No. So when we say customer is when we initiate a sales with them. In this case, this is only an LOI, which where the sales are not initiated. So all these three LOIs are with the new customers actually. So probably next year you will see a few more addition to our customers.
Got it. And this capex guidance of 350-400 crores that you've given, when do we see it start commercializing?
Probably at the end of the year or a quarter after. So let's say end of this financial year stroke first quarter next financial year.
Okay. And all of this is largely the fluorination capex?
Both. As we had said that there is one capex which will go for the LOIs and contracts that we had signed, and earlier LOIs and contracts that we signed, and two for the fluorination block.
So roughly around 250 crores for LOIs and the rest for fluorination.
Yeah, you're right.
Okay, just one last question, if I may squeeze in. On the margins for the fourth quarter particularly, the standalone business has seen a little bit of a dip. If you could just explain what has gone into that and why margins have taken a bit of a hit in fourth.
So if you look at it, largely you should look at us more from an EBITDA perspective rather than only gross margin perspective, because typically we will be looking at negotiating with our customers mainly on the PBT EBITDA levels of margins. And this aberration that you saw in terms of this quarter is largely coming from the product mix changing, and couple of products which were of where the margins on the gross margins were little on the lower side, but at the EBITDA level they were at the same levels. Because typically my EBITDA levels are where we look at the profitability from, right? And if you look at for the year number, that year number will look more reasonable, where those gross margins will be in the similar range at what we would have expected, and EBITDA margins also at the same level that we looked at. So I would not read much on the quarter number, and I would probably read the annual number as a representative of the business.
I meant the EBITDA margins excluding the other income. They have sort of declined by roughly 400 basis points for the quarter.
So that's probably basically a quarter entering and quarter exiting numbers that would have moved around, but largely it will be back to the numbers that we have been seeing.
Okay, but the trend in improving product mix and higher margin, the share of higher margin products remain, and we could probably see these normalize in the next year.
Absolutely. It's just the scheduling and the product mix that we would see.
Okay, thanks for these. I'll get back into you.
Thank you. Sure. Yes. Thank you.
Thank you. Ladies and gentlemen, in order to ensure that all participants are covered in the question queue, we request you to please limit your questions to 3 per participant. The next question is from the line of Rohan Gupta from Nuvama. Please go ahead.
Yeah, hi sir. Good evening and thanks for the opportunity and congratulations on this set of numbers. Sir, a few questions on my side. So first is on this LOI itself. If you can, you have mentioned that in the last 3 months we have signed more LOIs worth 2,800 crore rupees. Actually, if I remember that one was announced in a niche fluorinated molecule recently, which you have announced is a 380 crore rupees molecule opportunity with a 76 crore rupees revenue potential. I just wanted to get more on these 2,860 crore kind of number which you're talking about. If you can some more details on this, sir.
Okay. So what more? Because there is limited that we can share as of now, as long as the confidentiality is also there. But what we are saying is yes, these are all fluorinated products going into API and engineering fluid applications. So this is where we are. The 380 crore number that we had said, and the other one that we are talking about is again in the fluorination side, which is what we had talked about, of the 1,500 crores worth of one, which will be into fluorinated more on the polymer side of the application. And the first one that we signed around 1,000 crore number, that is one which is mainly gliding over on the side. It's an AI.
So the third one which you mentioned, how much was that?
It's a 7-year contract. Third one is around 100,000 crore number over the 7 years.
For the 7 years. And the second one you mentioned was 1,500 crore.
My bad. Sorry, it's 6 years. My bad. It's 6 years. Sorry.
The third one for 1,000 crore is 6 years. Yes. The 1,500 crore is for how many years?
1,500 crores will be for 7 years.
Okay. Okay. And sir, both of these two molecules, 1,500 and 1,000, both of them are in fluorination, sir?
1,000 would into fluorination, but others are into fluorination. So all are into fluorination. My bad. Sorry, these all are into fluorination.
Okay, so all of them are in fluorination. So when you talk about the fluorination, so these are the further, enhanced molecules in HF categories and HF-based chemistry, or they are in a earlier chemistry, we are using clear-based chemistry, which part of the chemistry they are involved in these products in fluorination.
So these are the ones. See, these are all the contracts which have been LOIs that we've been signing after the acquisition time track. So you can appreciate where they are coming from and what chemistries they are in. But yeah, largely they are the chemistries which are more from the HS side than the KS side.
Okay, that's good. The specific timeline for these molecules will be once again, we can expect the commissioning of these products in next 2 years, or any longer or shorter?
So as I had mentioned earlier, these LOIs, of which at least 2 molecules we should, from these LOIs, at least 2 molecules we should expect in this year, and the balance you should expect in the FY25. And the full ramp up should be seen in FY26 or 2 years basically from here.
Okay. Sir, as far as the customers are concerned, that one is Japanese and another is an American MNC in English flavors in these. These are the ones again new customers or for the existing set of customers you again before?
Sorry, I couldn't hear you well. Can you just speak up aloud?
Sorry to interrupt you, Rohan Gupta. I would request you to please speak through the handset.
No, it's okay. Yeah.
Sir, I was asking that these are the existing set of customers or the new customers in fluorination which you have been able to get?
These are the new customers that we have.
all the fluorination customers are actually
all the three. So I repeat, I'll just clarify. All the three LOIs that we have signed are new customers that we are going to add. In this year's presentation, if you see, we have only added one MNC customer. That was for the sales of the product that we have done. These are the LOIs which will convert, which will translate into sales this year and next year, and so they will become my revenue-paying customer FY24 and FY25. And that's the reason you would be able to see that you are just, this is the question, right? So all three are new customers.
Okay, that's great, sir. That's fantastic. So just one last, and I'll come back in queue. So, sir, these customers are looking at fluorinated solution. I believe that there are those who are already there in the country. So I'm sure that these customers have come to us. They must have seen something in partnering with us. I'm just asking that most of these molecules you also mentioned that they are the new molecules as far as India is concerned. I just want a little bit clarity. These molecules which we have got, they are the new feature product development. They are existing. They are the existing players which are replacing some other country or suppliers like China or Europe.
So largely, if you see, these are all the products which are typically manufactured by customers existingly today, or maybe sourcing from Europe or Europe and other geographies, right? These are the products which are not being manufactured or sourced from in India, right? And that is where what we are saying is that we would have done it in first time in India. And one of them is a new product, or a couple of them are also new, which are launched by my customer also. So they are first time moving out of their manufacturing facility to us. Okay?
Fine enough. And they are all intermediate mainly for end products. I mean, there is none of them are AI or final products.
There is an AI in it as well.
No, I'm thinking that all these products are intermediate. There is no final technical or final ingredients, right?
That's what I'm saying. Obviously, one of them is an AI. Others are intermediates to polymers or API, intermediates to API or engineering field.
So one family.
Sorry to interrupt. So I would request you to please come back in the queue.
Yeah, thank you so much.
The next question is from the line of Vishal Biraya from Max Life. Please go ahead.
Thank you. Just to take forward Rohan's line of questions, after the contribution from fluorine-based intermediates, fluorine-based business in 24 and in 25 as these molecules scale up?
Okay, so I'll tell you, today it is around about 15% in my portfolio, and we expect that contribution to expand. I would be preferring not to speak a specific number in terms of it, but we should be adding. It should become 20 to 25% of my contribution in next 2 to 3 years time.
Okay.
So it should be 20%. Okay, let me do 20% by FY24 and 30% by FY25.
30% by
27.
30% by 27. Okay.
Yeah. Give me an allowance of a couple of percentage points.
No, obviously. That is about direction. We need a direction. The numbers will fluctuate. That is okay.
Yeah, but it will also depend upon my other businesses also growing and other molecules growing. But yeah, largely you can see directionally, here what we are trying to say is directionally where we will go.
Fair enough. And how will you be getting HF and KF to do that? To Sachin from...
First is that Tenpac is my subsidiary and the second is also we would have an arm's length transaction with them. With them in terms of, because they are also listed and we would be also listed, so we'll do an arm's length transaction with them. And the last and one more thing is we will try and source the one step forward, or from HS we'll make it into a step which is more amenable to travel export and move it to the Anupam sites.
Okay. You will do one step at Tenpac and then get the step.
Exactly. And Tenpac will have its own growth. I would not be able to discuss now. We can have separately do it, but yeah, that will continue in that side also.
Right. And on the slide number 23 of the presentation, you've written that Anupam Sanpa is the only manufacturer of niche molecules in fluorination. So what exactly are the niche molecules that you are referring to? You are the only one?
Just a minute. Let me read that for you also along with you, right? Just give me a minute.
Slide number 23, Anupam Sanpa integration.
Yeah. Only the manufacturer of niche molecules. What we mean here is not that we are the only manufacturers of fluorinated products, but the products that we will manufacture those products will be new to India. We will be the only one manufacturing today, or we will be the first one to manufacture in the country. So that's what we are saying. There are my peers in the industry who have been doing fluorinated products and for a long time. Here what we mean to read is the products that we do will be the niche ones which are not produced in India, and we have our own niche in which we will be operating here. Like what we talked about, fluorinated polymers and this. Again, in polymers, my peers are there who do a different polymer range, and we will be doing a different polymer range.
What will be the extent of backward integration for you for this particular polymer?
Extent of backward integration, so we'll start from HF. So we'll start right from the starting material, we will be able to bring it up.
Okay.
Over the time, yes, for sure, because we will have to build the whole supply chain, but yeah, that's the kind of we'll start from HF.
Okay. And then this is the last question. What is your HF utilization? How many points of HF do you utilize currently, and how much will you require in 24, 25?
Okay. So see, this will all depend upon my ramp up of the business, and I would rather say that today my HF utilization will be very limited, which is more on the sample and these side, because now we are going to commercialize the HF products, and as we start doing it easier. Today, large portfolio of our is based on the KF portfolio.
Thank you. The next question is from the line of Krishan Parwani from JM Financial. Please go ahead.
Yeah, hi sir. Hi Anand and Vishal bhai. Congratulations on the order wins and good set of numbers. So 4 questions from my side. I'll limit it 3 actually. So first is, what is the kind of inventory levels you are envisaging going forward? I mean, also these new order wins are priced on 6 months or annually? So that's the first question. I'll ask it one by one.
Okay. Okay, you'll ask one by one. Okay.
Yeah.
So first is the inventory, as we have been focusing on. We will try and bring it to the lower numbers that we have been indicating. We should be going back or below what we were in FY22 and FY21, my bad. So what we were in FY21 or below that.
Okay. So I mean, if I just put in the number to it, it's FY21 inventory levels were at around 222 days. If I'm right.
We should be doing better than that. Our target will be to do better than that.
Okay. So even better than FY20 or like
give me a quarter or two to answer that.
Sure. No worries. I'll not go into okay. So these new order wins, how are the price? 6 months or annual?
Yeah, they are a combination of annual and 6 months. One of the customers will be more on the annual side, but largely they are on the 6 month side. Most of them are on the 6 months, and we have an option to price it on a 6 monthly basis.
Understood. Okay. So my second question is on, so would our margins be initially lower than the company level EBITDA, especially in the beginning, since these are new products for us?
Typically, you can say, but it's not significantly really it moves up because the volumes are also pretty low at that point in time. But the moment the volumes increase, we go back to the margin that we have been. So I don't see any impact of these into my margins.
Okay, so you expect, let's say, whatever standalone margins that you did, 28.6% in this fiscal, you think these are sustainable in nature, or you would rather guide for more like 26%?
I have always been trying to guide at 26 to 28, and always it's great. But not because molecule, typically we believe we're robust at 26 to 28% EBITDA margin. There is a possibility margin, but typically 28 is where we would be. And also mind you, the dealer which are of high value products that we are talking about. My ASP is increasing significantly in this case, if you really see that. So the room for margins will also be higher. So there is a two-way play that plays out here. And I would not want to say otherwise, but I would guide with 26 to 28 and leave it there for now.
Understood. That's helpful. And two small clarifications. So, not sure if you've already given this, but is there a breakup of, let's say, capex for FY24 in terms of fluorination products and the non-fluorination, and similar for FY25, if possible, if it's there?
So let us have a block one, because this is all projects that are happening, and they are all in the brownfield expansions, right? So what we are saying is large part of mine will happen by this. But on the fluorination side, basically the LOI is 250 and the balance is fluorination 670 out of that. So 420 odd crore will be coming from fluorination and 250 will be LOI.
Okay. That's great. I mean, so 670 is what we are deciding for 24, 25 inclusive, or there could be more in 25?
Right now, this is the capex that we have guided for and announced. So we would leave it there. If there are any more, we'll come and update you on that as well.
Sure, sir. Just small little clarification. Since you mentioned about you'll be doing one step at Penfec, so do you have the capabilities there? I mean, have you changed anything, or will you be just diluting HF?
So it is a combination of, in few cases it maybe dilution will be good enough, or in few cases there will be one more step that we may do. But these are all the capacities are there, and there are small bit of some amendments that have to be done, which we do that.
Understood.
And Anupam will support in helping them do the steps that are required. So it should be a combination of both that would be.
Thank you so much, Vishal Bhai, for patiently answering my question, and wish you all the best.
No problem. Welcome, and thank you for the wishes.
Thank you very much. The next question is from the line of Rohit Nagraj from Centrum Broking. Please go ahead. Rohit, your line has been unmuted. Please proceed with your questions. As there is no response, we'll move to the next question from the line of S. Ramesh from Nirmal Bang Equities. Please go ahead.
Good evening, and thank you very much. So if you look at the capex numbers you just shared, it's 420 for fluorination and 250 for LOI. So together, this represents whatever is the additional capacity required for the new LOI which you have signed in March and April. Am I correct?
So what we have said, if you see the announcement of the capex was done during the August-September time period, which is when we had a 2,600 crores of 2,650 crores of LOIs, 2,600 crores of LOIs that we had signed, and that was to service 250 crores was to service those LOIs, plus a 420 crores of revenue for the capex for fluorination. If you look at so that's the total revenue, total capex that we are looking at from now. If you look at this should practically at 1.75 times a run as well, asset turn as well. We should to give a revenue of 1,100 to 1,200 crores of revenue, and that's what it is. And in the fluorination, there are few LOIs which we have signed from here also will be serviced from the fluorination blocks that we are establishing.
Okay, so to put it in perspective, for the new LOI 1,500, 980, and 380, you don't need any further capex, right?
largely we should not need that for now. We don't need that. That this coordination block should be able to service that.
Okay. So if you put all these numbers together and look at, say, 26, 27, you have existing revenue on a standalone basis, 1280 crores plus this 700 crores. So you are saying that you will reach about 2,500 crores without assuming any growth in the existing revenue, right? So what is the growth? So in terms of the estimates, if you look at 26, 27, assuming the revenue of close to, say, 1,000 crores from the new LOIs, what is the kind of growth one should expect in the current, base revenue which you have reported in FY23?
Mr. Ramesh, what I will try and do is it will be not an ideal thing for me to give you a specific number for a specific time. But what I can suggest and say is that the kind of revenue growth that we have seen historically, we should be able to see that on a standalone basis. And that's what we would say for next 3 to 5 years, we should be able to see that. That's what I would leave it at.
So the question here is, some part of that is, coming from existing contracts, and these contracts will have a certain life, right? So can we attribute any YOY growth in those contract revenue, and then what is the chance that they'll get renewed? That is the angle from which I'm asking that question.
So fine. That I can answer and say that if you look at my contracts, so if you see typically when you see any of these contracts, it is not that these contracts are having a sunset clause in that sense that they would stop buying from us. Because if you look at historically what has happened, the demand that we had for a product, let's say in 2006, it continues for even till today. So if you look at it from that perspective, what demand comes to you typically stays with you unless we make a big error or a mistake and we don't deliver on promises that we have given on a gross level basis, right? And so when the contract, let's say 5-year contract ends, it is not as if that they move to another party. Because see, what happens in this our business, as you are aware of the custom synthesis business, there is a lot of optimization that happens over a bit of time. A lot of knowledge transfer happens, knowledge gain that we have. One is initially there is a knowledge transfer or knowledge discussion and agreement, and then as we work over a period of time, that knowledge is only expanded and the process are optimized. So the moment you do that process optimization, that is where our customers will keep staying with us. And also you have to appreciate that there is always a supply chain that gets created around that. So for me, when I'm doing, let's say, 5-step process or a 10-step process, that at each step there are a lot of raw materials and inputs which come in and that is it. So the kind of process optimization, capacity and supply chain that we create and the value engineering and enhancement that we do, typically you don't see customers moving out. And also for customer also there is no reason for them to move out and go to somebody else, because there's so much of an effort to change any vendor from one to another. Unless you make a big mistake, you will not lose that. In our history, we have not lost a client on that count.
So does this apply to even the molecules which are near or?
I would request you to please come back in the queue, sir. I would request all the participants to please limit their questions to 2 per participant. Should you have any further questions, you may join the queue back. The next question is from the line of Rohit Nagraj from Centrum Broking. Please go ahead.
Yeah.
Rohit, sorry to interrupt here. Your voice is breaking up. No, you're not in the network coverage area. I would request you to please come back in the queue.
Yes.
The next question is from the line of Madhav from Fidelity. Please go ahead.
Hi, good evening. Thank you so much for your time once again. I just thought if you could just share a bit more of an updated view on the kind of opportunities that companies like Anupam and other players in the sort of CRAMS or CDMO space in India are seeing, just in terms of Europe plus one, China plus one. I know this is something which is discussed quite often, but just your updated thoughts on what's happening there. Are we still seeing strong traction of business moving out, and how companies like us can sort of scale up in the next 5-7 years?
So So fair one, Madhav, and frankly, you've used the word updated as well, because there is a kind of a view that gets updated time to time. As you rightly said, there is a Europe plus one, China plus one approach. Yes, there was a time when the energy prices and the other costs had gone up significantly for the European manufacturers, and China was off the grid. However, the prices are now coming back to more reasonable levels or more rational levels in Europe as well, but they are not as low as what they were pre that event. So the new normal is not the old normal, but yes, it is not so high as well. But what has happened with this experience, and everybody has a memory, and especially supply chain managers have a very high aversion to any disruption or a spike on either side in terms of the supply disruptions or the price disruptions. And that is the reason that you will see that there is a consistent flow of inquiries to the players like us and in India, and that is for two reasons. One is they want to diversify their supply sources, irrespective of what they would do in Europe. So I'm not saying that everything from Europe will move to the Asia, but now allocation is increasing, and they are introducing Asian players early in the life cycle than only in the later part of the life cycle. So both is happening together, and we see that trend continuing because of the structural reasons that I was mentioning. That once they have seen that shock wave, they really believe that they have to find an alternate, and they have to do there are various words for that like BCPs and other, but they would do that. So in summary, what we are saying is Indian players like ours and our peers should see a good quality of inquiries, and that's what we are also seeing here, and that's also the reflect. Our LOIs and the current conversations are a reflection of that as well.
Got it. And I just wanted to understand, like some of our contract wins which you all have announced, especially the ones which were announced more recently, there were some engineering fluids, fluoropolymers, electronic chemicals, etc., which are coming in. So how do you see the mix of revenues between agro, pharma, electronic chemicals, and other sort of end markets after next 3 years? Like how should the mix look? I'm assuming like the mix of agro will kind of come down. Is that the right understanding?
Yeah, you're right. See, the agro mix would come down a bit for sure, and the contribution from pharma and the polymers would go up. But mind you that my agro business is also growing, so there will be a fair bit of churn, not churn I would say, but that addition will be gradual. Though the growth of these two category segments will be high, but the share in my revenue will take a little bit a gradual flow for that, and that's all I would say. But yeah, they would go add. They will be higher in my revenue as we go further.
Got it. Okay, thank you.
Thank you. The next question is from the line of Dhruv Muchhala from HDFC Mutual Fund. Please go ahead.
Yes, sir. Thank you so much, and congrats for the recent wins. The first question is on the CapEx, the 670 crores that you mentioned over FY24-25. Does it also include the Denpac CapEx?
No, Denpac will do their independent CapEx from their own balance sheet. This is the CapEx that we are doing for our own capacity and requirements.
Sure. And the second is a bit conceptual. So you have announced LOIs and contracts. So conceptually, what's the difference between an LOI and a contract?
So LOI is the initial level at which we initiate the relationship, and that's where it's there. And then we tend to convert into contracts, or there are a few customers who may start the purchase right from the LOI stage itself, and it will depend upon the relationship that we have and the comfort that we have with each other. Either we end up converting into a contract, or we do the business continuing from an LOI phase as well.
So for all practical purposes, for us, the LOI and a contract is same.
I don't want to stamp it that way, but you are right that once you have an LOI, there is a very, very high level of visibility in terms of revenue. It will be only really, if we make a big error, otherwise we are producing. And that is the same when we are even the supplier also. So yeah.
Sure, because earlier the understanding was the LOI gets converted into a contract and then it probably start recognizing revenue. So, but that is not the case. And LOI also can directly start reflecting in revenues, and broadly an LOI will be effectively a revenue generating.
Yeah, see, what is an LOI is also basically spelling out the contractual expectations of each other, right? And that you make it into a contract and sign it, or you continue doing it. It's matter of two a buyer and a seller really just being comfortable with what is the level at which they want the comfort and the clarity. But yeah.
Got it. That's helpful. The last question is, now at the time of IPO, our inventory days were about 200 odd, and since then, with the addition of these LOIs and contracts, revenue will scale up significantly. But I'm just a bit curious about your inventory days guidance. It's still about 200 or sub around that. But given that most of these contracts are new and probably you would have signed at better terms, just doing a rough math, all new contracts coming at better inventory days terms would probably take your inventory days once the full revenue run rate is achieved below 150 or below even probably 130 levels. So just wanted to get, is that directionally correct, or is there something which I'm probably missing?
If you look at it, the LOI will start contributing significantly in 25-26, and so 24 is what I was mentioning that, right? And hence I'm saying this number. And as we go, yeah, that number will improve. Will it go to the numbers that you are speaking? Let us discuss in few quarters from here on. But for FY24, that's the number that we are trying to suggest.
Yeah, because I understand in your earlier conversations also you were mentioning even your existing business, I mean, in the FY22 level businesses, you were renegotiating those contracts as well. So the inventory days should improve there itself, plus the incremental contracts that you have won would come at better inventory days, I believe, and hence the overall numbers will look meaningfully different. The inventory days or the overall working capital will look meaningfully different versus what it is in FY23, 24, once you achieve the full run rate, FY26, probably 27.
Yeah, it should. I will just share a word of caution that when we are also a primary or single supplier to our customers, they will also expect a part of the finished goods to be also held as a buffer inventory for them also in terms of their supply. So to that extent, you have to give an allowance for that. But you are right that directionally you are right in terms of the extent it will evolve as we go.
Okay. Sure, sir. Thank you so much and all the best. Thanks.
Thank you. The next question is from the line of Chetan Thakur from ASK Investment Managers. Please go ahead.
Good evening, sir.
Hi, good evening.
Yeah. So just wanted to check out of the LOIs and contracts which are signed between Q1 FY22 till Q4 FY22, which is an annual peak run rate of 530 crore. Are those contracts already at peak, or is there scope for them to hit peak in 24?
It will take, so as we had mentioned earlier, of that we have commercialized four of the molecules and around 100 crores of revenues coming from there, and that will expand in FY24 and also in FY25 because there are few which will ramp up in FY25 period as well.
So your FY24 revenue breakdown will be some of these molecules hitting peak in 24. Contribution starting from the 3 LOIs that you've just won. So out of that, 2 will start to contribute. And whatever is the organic growth in the base portfolio. That should be a fair understanding.
You're right.
And sir, any indication from customers, particularly in the agro side, in terms of the slowdown that they've been guiding? So a few of them have come out and said that there is inventory in the channel. So is there any word that you heard from them around the same?
Okay, let me give a first shot at it, and probably Anand can also add on to this. But at least in terms of the revenue projections or comfort, we are not seeing that happening. In fact, in few cases, it has also increased in terms of their expectation from the revenue from the volume that they want to uptake. But Anand, please, if you want to add on to this.
No, I think you have covered well.
Sure. So nothing as of now from their end to you?
No.
Sure, sir. Thank you so much. All the best.
Thank you.
Thank you. Due to time constraint, this was the last question for today. I now hand the conference over to management for closing remarks.
Okay. Thank you everyone for joining this call. We hope we have been able to answer all or most of your questions. If you have any further questions, please feel free to reach out to our IR agency, EY, and we will get back to you. If you need, we are happy to answer any more questions through EY or otherwise. Thank you for joining us and being part of our journey. Hope that we make this journey of ours meaningful with each other. Thank you.
Thank you. On behalf of Anupam Rasayan India Limited, that concludes this conference. Thank you for joining us, and you may now disconnect.